In this video, I'm going to show you exactly how to deal with impending possible world crises and planning your capital raise to acquire some more assets. So you want to make sure you listen to this video very carefully because things might change and you want to see the different scenarios that play out by the end of the videos. But basically, the idea is Ukraine's war budget is basically running out. And we have different situations where people are worried about global tensions rising. So back home in North America, to many of the people who are watching this video, how exactly do you deal with it and how do you win in terms of people that want to raise capital to acquire some more real estate or businesses? So just know that number one, there are global tensions that have the possibility of escalation, and you always want to plan for the worst cases. So when it comes to escalation, you have different countries that are barring different levels of trade and having sanctions against Tel Aviv and Israel in general. That's number one. Number two, you have Ukraine's war budget, which is drying up because without getting into the politics, you know that Russia is this giant country and Ukraine is a less giant country. Although supported by other giant countries, it's going to be sort of a gridlock. And the third thing is, we know that the US president muttered that the Chinese president was a dictator when asked by a reporter at the end of the interview just a few moments ago, so a few days ago, according to this video. It seems as if they may just wait for the US to be busy dealing with the other fires while China may go ahead and cause some more action with Taiwan. So with all these concerns rising, that's one thing to worry about, because the concern and the way that may affect the local capital raises in North America, according to our chief economic head, the person who really is a chartered financial analyst at raises.com and helping the clients with global strategy. It's more just looking at saying, hey, we have all this foreign investor money that's drying up, and a lot of the capital that we're getting, it has to, we can't even get into national capital as we used to. So a lot of people are focusing on local capital. So that's number one. Number two, because the interest rates are so high and the inflation was so high, so the government increased the interest rates to deal with the inflation, everyone bumped up the interest rates. But the problem is that when the interest rates got bumped up, it's slowing down transactions that happen. And why it's slowing down transactions that are happening, and you want to make sure you listen to this because this would explain how you can take advantage of this, is because the prices of some properties are supposed to go down, but some people who are looking to raise money for deals to get them underneath their fund are saying that, hey, the sellers of some real estate are not giving me over the deals. Like there was somebody in Florida that I was talking to, he's getting only half the deals in this fund as he used to sell to potential Canadian investors through his fund. And he's saying that because of that, less people are moving the deals into his, like he's able to get less deals under contract to agree to put them into his fund because they're not able to settle an agreement between the price that they want to buy the houses at, which he knows that are valued less than what they want to sell them at. So what the people with the properties are doing, they're just holding the properties and they're not selling them over to the person with the fund who wants to acquire them. So there's a disagreement and there's less movements between the assets from person to person, which has resulted in less loans getting closed, less deals, less trades of businesses, less trades of real estate in general. So that can slow down the market, slow down the amount of money people are making, which will slow down the economy. And there's also more expensive debt, so people are less able to get access to debt, especially the young generation that is more consumer heavy and consumer centric. So that is happening. How do you win in that situation? The good news is things may be turning around. So because the unemployment rate hasn't skyrocketed, people are noticing that there's a slowdown. So it's likely that amidst the slowdown, rumors are coming out that the interest rates will drop. And another thing is there have been a unique type of bank bailout. So because banks get paid, or the value of a bank is valued based on the value of a bond. So banks sometimes own bonds or they own loans. And the value of a bond goes down when the interest rate goes up. So that means that a lot of the bonds that a bank is valued by will decrease in value, which is problematic, and it's a problem because that means that they'll go down in value due to the high interest rates. So one thing that the different governments are doing, especially in the US, is that they are lending, they are actually offering to buy back bonds from banks at the value that the bonds were before the interest rate went up. And so because of this, that's sort of a way of quote unquote bailing banks out and helping to speed up the economy with respect to the banks. So it almost provides the same results, or the same like a lower interest rate in a way, just for the banks who are affected. So they found this new way to kind of bail some banks out. And so the good news is that this may unlock some capital that was stuck with the institutional investors who depend on a lot of leverage. And so that may speed up some capital raising on our side. So what this means is you want to be proactive in talking to banks who were previously saying I'm locked up, in actually offering out capital for you to lend to, or to get access to equity. So maybe just talk to the boring institutions again and be more aggressive in reaching out to them, because perhaps they're going to loosen up due to all these bailouts that are happening. And there's also sort of a renewed, looks like things are turning the corner slowly because of a renewed hope that the interest rates will go down. Not nearly as down as it was at 0%, but they will go down. And lastly, people are not really sure about what's going to happen in the future with regards to escalation of a war. If you understand, the world is not really as it used to be. It's definitely dipolar, and the capital in the US is going to probably stay in the US. The capital not in the US may not even cross the US as much. Then you understand that you have to just have two different strategies for raising capital locally or internationally. So I hope this provides some context. But in a nutshell, people are not sure about the future. But what you should be sure about is understanding people are still trying to bail out banks. Banks may open up some capital that they have had restricted. People are seeing that interest rates may turn a corner, and international capital may be more tricky to get a hold of because people are using confidence in the US, and they don't want to be sanctioned by the US. So they're saying, hey, why are we going to transact with the US dollar? Let's just keep our money in our own economies and build our own trading routes. So with this, I hope this brings some clarity in the path forward. And if this is something that you want to apply to your situation, first of all, just subscribe to Raises.com, to this channel. You get entered in a giveaway. And if you're ready to start creating a capital raise or a fund, just head to Raises.com to learn more.